Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories within corporate filings. Sometimes it is about growth, sometimes it is about saying goodbye to old deals. Today we're diving into what MultiSensor AI Holdings Incorporated has been up to. Get ready because this report might just be about closing doors, but sometimes that is how new ones open. Before we jump in, if you like getting straightforward insights from these financial documents, make sure you are subscribed. And hey, we've got a growing community over on Discord. Link is in the description below. It is a great place to chat about these filings. Alright, let's get straight to it. This is a Form 8K filing, which is for companies to report major events that shareholders should know about. Think of it as the news alert system for the stock market. The big news here is about agreements the company had and their termination. MultiSensor AI Holdings had an agreement called a Common Stock Purchase Agreement with B. Riley Principal Capital II. Incorporated, essentially, this deal, which started back in April of 2024, gave the company an option. They could sell up to $25 million worth of their own stock to B. Riley Principal Capital II. It was like a safety net, providing potential access to cash if they needed it by selling shares. But here is the kicker, effective the 2nd of February 2026. They decided to end this agreement. Now, why would they do that? Well, they did sell some shares under this agreement before terminating it. They sold over 1.8 million shares, bringing in about $4.7 million. So, they used it a bit, but then decided it wasn't needed anymore. The good news for them is there were no penalties for ending it, which is always a plus. Then there is another deal, an at-the-market offering. This was an agreement with B. Riley Securities Incorporated starting in March of 2025. This one was for up to $8.6 million. Think of it as a way to sell shares gradually, whenever the market conditions seemed right. It is another way for companies to raise money without a big fanfare. Just like the previous agreement, this one also got the boot on the 2nd of February 2026. They did manage to sell a smaller number of shares here, about 151,000 shares for around $116,000. Again, no termination penalties, which makes sense if they just decided they didn't need this specific way of raising capital anymore. So, what does this all mean? MultiSensor AI Holdings Incorporated is listed on the Nasdaq, trading under the ticker MESI for their common stock and MESI for their warrants. These agreements were essentially ways for the company to raise money by selling new shares. When a company terminates these types of agreements, it can signal a few things. One possibility is that the company has secured funding elsewhere, or perhaps they feel they no longer need to access capital through these specific channels. It could also mean they've achieved certain financial goals, or that their strategy has shifted. Another aspect is that the company elected to continue using the extended transition period for complying with new or revised financial accounting standards. This is something emerging growth companies can do, giving them more time to adapt to new accounting rules. This filing is signed by Robert Nadolny, who holds the roles of Chief Financial Officer and Secretary. This tells us these decisions were officially sanctioned at the highest financial and administrative levels of the company. Now, let's look at the bigger picture. The company is choosing to terminate these capital raising agreements. On one hand, this could be seen as a positive sign that they are managing their finances efficiently and don't see an immediate need for raising significant funds through dilutive means, meaning selling more stock which can reduce the value of existing shares. However, it is also worth considering why these agreements were in place to begin with. If the company is terminating them because they have strong cash flow and ample reserves, that's great. But if they're terminating them because they've run out of options, or if market conditions make selling shares unattractive, that could be a sign of underlying financial challenges. Without seeing their full financial picture, it is hard to say definitively. Looking back at the agreements, they were for significant amounts, $25 million and $8.6 million. The fact that they only utilized a portion of these facilities, totaling about $4.7 million and $116,000 respectively, suggests they were either cautious or perhaps not as cash-strapped as initially planned when these agreements were put in place. The company is also flagged as an emerging growth company. This status gives them certain regulatory advantages, including the ability to delay adopting new accounting standard updates. The fact that they have elected to use this extended transition period means they are likely operating on a more conservative timeline for financial reporting changes. Overall, MultiSensor AI Holdings Incorporated appears to be making strategic decisions about its financing. The termination of these agreements points towards a company that is actively managing its capital structure. The key question for investors is why these agreements were terminated and what the alternative plans for funding growth or operations might be. If the company is on solid financial ground, this could be a smart move to avoid unnecessary dilution. If not, we'll likely see more news about their financial situation down the line. Alright, that is our quick decode of MultiSensor AI Holdings' latest 8. What is your take on these terminated agreements? Do you think it is a sign of strength or caution? Let us know in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more regular corporate intelligence. And don't forget to join our Discord community to keep the conversation going. Thanks for watching, and we'll see you in the next one.